member of the executive board of the European Central Bank, sometimes called the chief economist. You have the floor, Philip, and you may directly respond, if possible, a little to our UK European participant, Martin. You have the floor.
Sure. Good morning. Thank you for the invitation. And I suppose in line with the some of the other contributions so far, I think this session is maybe has an interesting intersection between what it takes to come through this pandemic period, but also to look at the longer term determinants of income levels and living standards. And of course, these are not independent processes. We know that longer term performance will be contingent on recovery from the short term pandemic shock. Because we know if you have a sustained period of below capacity economic activity, it's going to hurt the longer term capacity of the economy through several mechanisms. Labour productivity will be hurt if there's a loss of on-the-job knowledge accumulation. That's compounded for those entering the workforce from school or university, given the adverse impact of the pandemic on educational systems over the last year. We also have a capacity risk in the corporate sector, because we know the loss of revenues during the pandemic has weakened corporate balance sheets. And we know from the last crisis that corporate balance sheets are an important determinant of investment. So there is a clear risk if corporate balance sheets are too damaged, that the reduction in capital accumulation will threaten long-term living standards. And I think also a related point is that firm-specific knowledge capital will be at risk if the revenue shortfall is so large that we have the closure of otherwise viable firms. Another intersection point is the pandemic is an uncertainty shock. So not only is there uncertainty about the timing of the exit from the pandemic, due to the, of course, on the one side, the promise of vaccinations and other medical treatments, but on the other side, the ongoing challenge to spread the spread of the virus and the risk of mutations. Another, in addition to that medical uncertainty or public health uncertainty, we have uncertainty about the future of various sectors. So many times we've all debated the balance between the office and the home as a workplace, as well as the issues maybe thrown up by the international issues thrown up by the option to work remotely from any corner of the world. It's also the case that, like this morning, our accumulated expertise now in online meeting and collaboration technologies will reshape international activity in terms of the organization of firms and international business travel, of course. So why am I emphasizing the uncertainty? Because the uncertainty gives rise to the risk of self-fulfilling adverse dynamics, by which uncertain economic prospects induce households, firms, and governments to hold back on expenditure plans, leading to a decline in overall demand that ex post validates the loss in confidence about the future. This is compounded if we get a further type of amplification, which is between the real economy and the financial system, by which lenders, whether bank lenders or bond investors, become reluctant to lend, and borrowers, whether households, firms, or governments, become reluctant to take on debt because they fear that lower growth prospects will be amplified by declining creditworthiness and a tighter credit supply. So in that world, with the risk of those self-fulfilling dynamics, it's essential that central banks, including the ECB, act as a stabilizing force and boost confidence by committing to the preservation of favorable financing conditions. For us, this is delivered through our full set of monetary policy instruments: the low policy rate and the associated forward guidance, Our targeted lending scheme for banks, and of course through the PEP, our commitment to make sure that the scale of PEP purchasing will counter any tightening in financing conditions that is inconsistent with offsetting the downward impact of the pandemic on the projected path of inflation. Now, of course, the monetary policy measures, taking a wider view of central banking, have been reinforced by a range of supervisory measures, both microprudential and macroprudential. Now, it's important to also factor in the complementarity between monetary easing and fiscal easing under these conditions. And it's a kind of multi-level fiscal challenge to offset the income shock to those firms and workers who've been most affected. That's step one. Step two is to make sure that overall aggregate demand conditions promote a timely recovery. And then step three is to underpin medium-term prospects through growth-enhancing public investment and reforms. And of course, all of those are desirable under a wide range of circumstances, but they're especially essential under today's conditions. And in a context of fiscal multipliers being higher in a low interest rate environment, and in the context of the asymmetry of the pandemic on different sectors, meaning that fiscal policy has to come into it. It's not going to be sufficient to use monetary policy. Now, when we think about that in a European context, it's clear that coordination of national fiscal measures is important, given the spillovers across countries in terms of fiscal policy. And it's important that central fiscal capacity is used, which of course is primarily delivered by the innovation of the Next Generation EU initiative. And of course, I think the role it plays in this is really the last component, which is to provide a medium-term sustained engine for the economy through a public investment program, which of course is disproportionately targeted to those countries most affected by the pandemic. And I think side by side with that, it's a recovery and reform plan. So it's also the commitment to growth enhancing reforms. And of course, maybe having growth enhancing reforms side by side with a kind of large public investment stimulus is maybe a more fertile ground for reform than when reform is tried side by side with austerity measures. Let me point out, and as already been mentioned, I mean, it's clear that given that the need to have accelerated green investment and digitalization was already there, under these conditions, it makes sense to pull forward these investment programs and to have a big push in those areas. I think those are especially relevant for a pan-European program because there is a clear good element. We all benefit from an orderly carbon transition, and there are clear positive network externalities if all member states have enhanced digital capacity. So these, going back to what Martin was saying earlier on, I mean, the kind of, to me, the fundamental issue between the US and Europe is the US is a single market. And, with the fragmentation, not just in the financial system, but in all really sectors of the economy, it's very difficult in a world where scale economies are so important in the generation of superstar firms and really benefiting. This is why I do think the design of the EU programs has picked the right sectors. Of course, as always, the international public good element is there for support of basic R&D as well. Now, when we think about reforms, I mean, of course, there's going to be a lot of country-specific issues, but let me point out that I think everywhere, the most directly controllable element, what governments can do, is to improve the efficiency of public sector administration. I mean, this matters because public sectors are large in Europe. It matters because efficient public sector administration touches on the operating costs and resilience of all sectors of the economy. So this is why I was very interested in what you're doing in Russia in terms of shared know your customer systems, and then common biometric platforms. Of course, that's where the scale economies can be achieved. And then maybe the other element of this and why it's interesting, the next generation EU. Now, it's not just next generation EU. We also have with the SURE program, the unemployment program, we have a big expansion in EU level bond issuance. And this, again, I think holds the promise of being a kind of a direct route to developing a deeper and more complete pan-European bond market and adding to the stock of European safe assets. Now, of course, that's only one element. More general progress on banking union and capital markets union would also help in terms of boosting the prospects for the European economy. And maybe coming back to some of what Martin said here, I think it's pretty robust result in macroeconomics that individual risk-taking, entrepreneurial risk-taking is going to be more easily financed if all of those risks are pooled over a wide spectrum of underlying investors. And this is why the capital markets union is quite important. Now, an issue with that is I think that needs to be side with the single market and financial services should be side by side with a general push to a single market in all tradable services across the EU. Because I mean, I do wonder, Martin, in some of what you presented there, is that the causal factor? Is the causal factor the limited stock market, or is the limited stock market going back to the underlying lack of a full integration in the real economy? And that is the limiting factor. So if you don't have a pathway to become large in the European market, then selling out to the gigantic US firms may be individually rational for many startups. And sitting here in Dublin, where there's a lot of high-tech activity, it goes back to this kind of chicken and egg issue. And this is why the big push from policymakers, if we can work together, would be a good idea. So let me stop there.
Okay, thank you. Thank you very much. Perfect in timing. I may ask you later, if nobody else asks again, what you think of the US fiscal approach that Martin has described, whether this is something Europe would need or whether this can be overcome by other strengths of Europe that we may discover later in the discussion. But I move on.